Answer online at 560theanswer.com, on the AM 560 mobile app, on your Alexa-powered smart speaker, and on TuneIn, iHeart, and on Odyssey. This is Chicago's Morning Answer with Dan Proft and Amy Jacobson on AM 560. The Answer.
Top of the morning, Dan and Amy. So the Democrat Socialists in the House expected to propose raising corporate and capital gains taxes less than Biden had suggested initially, because as long as they get the $3.5 trillion, who really cares if they have any ability to pay for it? So to try and make it more palatable, still significant. You're talking about essentially a 25% increase in the corporate tax, plus a 3 percentage point surtax on individual income above $5 million, and about a 20% increase in the long-term capital gains rate. That's the proposal against the backdrop of this $3.5 trillion spend. And while Joe Manchin and Kristen Sinema still hold fast, we'll see. This is all posturing, of course. Nancy Pelosi and Comrade Bernie and the bar wench from the Bronx are basically taking the posture of all or nothing, $3.5 trillion or nothing. For more on what the impacts of what could transpire, the various things that could transpire, watered down on the tax increases and the spend versus the full Monty that Pelosi and gang want, what that would mean for markets and economic opportunity and growth. Please be joined by our friend Jim Iuorio, who's a Fox Business contributor and the proprietor of Brandt's Restaurant in Palatine. Jim, thanks for being with us. Appreciate it.
Thanks for having me.
Your reaction to what you saw proposed on the tax side and what we know has been proposed on the spend side.
Well, just to shed some light on one part of it, is that by the Democrats' own admission, like everybody knows this is not a surprise to anybody who looks at least 1 to 2 derivatives below the headline of raising capital gains tax. Every time capital gains tax has been raised, the revenues from that tax goes lower, not higher. And every time it's been lowered, the revenues from that tax goes higher, not lower. And this is not any sort of weird voodoo magic. This is obvious of why that happens, because as capital gains tax get higher, people don't take capital gains. They borrow money against things, they hedge things more, and the motivation's not there to sell things. Now, what I'm getting at is that they know this. They know that raising the capital gains tax will not raise revenue, it will actually decrease revenue, and they keep pretending that these taxes are to pay for the spending, where they've also shown us full well that they now adhere to the MMT theory, modern monetary theory, that suggests that they do not need to raise money from taxes. They can just deficit spend all they want and even create money, which right now is illegal, but they're trying to, at some point it might not be. So this is all nonsense. But the one good thing I take from it is that the notion that they keep kind of dialing it down a little bit, it to me seems that their heart is not really in it. For them, the show of acting like they want to be the guys who are coming after rich people is more important than actually coming after rich people. And I have my fingers crossed when I'm saying this, because this is a hope more than a prediction. But I think that's what's happening. But the markets are telling you that they don't believe them. They don't believe they have the guts to do it. That's what I see right now.
And you have Morgan, this against the backdrop of Morgan Stanley's chief investment officer predicting a 20% drawback in the markets. I mean, he's been predicting it actually since the fourth quarter of last year. So I guess if he holds to his prediction long enough, it's bound to become true at some point. But I mean, what do you think? Is something approximating what has been proposed, even on the spend side, already built into the markets? And this is all going to be, it's all going to turn on what Jay Powell does or doesn't do starting in November?
Well, absolutely, it turns on what Jay Powell does or doesn't do. Now I think we're at a much more of an inflection point in markets and our economic condition than people think. And I'm going to rewind the tape 6 short business days ago, the Friday when we saw the unemployment number, where the unemployment number came in bad. And that's under the backdrop of persistently high non-transitory inflation. So Jay Powell, so the word that nobody likes to mention out loud is stagflation. So we have to whisper it because, of course, it's early in the game. But if inflation is going higher and economic data is showing us that a slowdown is here, then the Fed is backed into a corner and they have to decide what to do. Now, the right thing to do is to pull back stimulus to fight the inflation and let the 20 to 40% correction in the stock market happen because they're the enabler. They're allowing the federal government to just use these asinine policy tools that to me almost seem like they're designed to slow the economy, and they know deep down that the Fed doesn't have the guts to remove stimulus. If the Fed did that, I think we could get back to some sort of equilibrium level that we're not at now.
Do you think since the incentives, $300 extra a week in Illinois, that ended, I think it's this week or last week, I do believe. Do you think more people now will jump back into the workforce instead of sitting at home?
Well, that's a good point. And I think the market is telling us, let's wait and see about the economic condition once that the child tax credit, the absolutely ridiculous eviction moratorium that I still don't understand, the extended unemployment benefits, the loan forbearance. These are all things that, there was 10 million open jobs, according to the JOLTS report, and at the same time the federal government was trying just to bribe, pay, just beg people not to work. And if we believe those programs are really sunsetting right now, which I think the market does, and that's why it's a little bit buoyant today, and that's why the sell-off of last week was it didn't really have a ton of conviction. It was 4 days in a row, but it still was only 3% off the highs. So I think that that's a big deal, Amy.
I don't know about you, but my friend that owns a restaurant told me last night he has to pay barbacks $20 an hour cash in order for them to work because he cannot find anybody to work in his restaurant.
Well, yes, I hear that from a lot of restaurant people all over that they can't find anybody. We're just going with some short staff at Grants, which I said we don't have the right amount of people to service people properly. But it seems like our people are understanding. But to underscore that is absolutely true that the restaurant business is starved for employment that just won't come off the sidelines. And I think you think about this, the eviction moratorium, just to circle back to that. So these people are being told there's 1 million jobs open for them, millions and millions, but you can't get one of those jobs to pay your rent. I'm just dumbfounded by all of this.
Yeah, but here's the problem with that. And talking about the 300, the impact, it seems to me, is unclear because you still have all the beneficiaries of transfer payments still have significant largesse provided by taxpayers, from food stamps to $3,000 per kid to rent paid. Plus, in many states, you have the enhanced unemployment benefits continuing at the state level. And so to me, it's unclear that the removal of the Fed overlay is going to fill a significant percentage of those 11 million unfilled jobs.
No, the removal of the Fed overlay is not going to solve those economic problems. It's actually going to pull back the wallpaper and show the condition of the wall and show how these policies are terrible. And then things could get bad, but the Fed cannot. See, this is, back prior to hyperinflation in the Weimar Republic, this is the exact same dilemma that the Reichsbank had. It's you see this inflation, you know that if you pull back what's causing the inflation, it could cause an cataclysm is probably the wrong word. It's a little too hyped up, but it's certainly possible. But if you pull back that stimulus, it could be a bad economic reset. But I still think they have to do that because we are beginning to risk, real sustained higher inflation, real perhaps currency problems.
And we're also now hearing rumors about revising GDP growth numbers for the fourth quarter of this year, third and fourth quarter, because Wall Street Journal, the front page story over the weekend, a lot of restaurants going back to limiting the capacity or emptying out their dining rooms because of the Delta variant. So because we're in this merry-go-round on COVID, you have one step forward, 2 steps back going on in a lot of industries, starting with restaurants and retail.
Yes. Yeah, no, and so many have closed, and we see it happening. I hear our restaurant's been fine and things are good. We have a ton of outdoor space, but I'm concerned about what happens in the winter. But what I'm more concerned about, and this began, and I don't know, I've been writing volumes on this for the last month. Everywhere the Delta variant has struck, it had about a 2-month cycle from bottom to top and then fell off precipitously. That was going to happen around this week. I mean, I still am sticking with that, and nationwide it is falling off hard, but in Illinois it hasn't quite yet. But that's why I thought the governor here was struggling so quickly to try to make put those mandates back in place so he can claim some sort of victory when it goes down on its own. That to me is just, you sit back and you think, wow, would they really do something like that, just putting these things in place? And the answer to that is, of course they would, and they did. I'm not convinced that some of these Democratic governors, at the beginning of all this, when faced with these huge fiscal issues and unfunded pensions, weren't really in some ways kind of glad that their economy was falling apart, because then they can point to the rubble and say to the federal government, gosh, there's nothing we can do. Look at what COVID did to us. Can we have some money? And that's worked pretty effectively from Illinois.
So does Powell's decision on beginning tapering in November and extending that through, the second quarter of next year, does that turn on whether it's $1.5 trillion versus $3.5 trillion? Does that matter in terms of impact, both on in terms of what he does as well as in terms of how America's economy performs?
Well, it has to. It has to, because $3.5 trillion injected in the economy is going to cause a tremendous amount of short-term demand, fake demand, and again, consider that juxtaposed against the real live notion that there still exists huge supply disruptions, and that's one of the reasons why we're seeing this inflation. But if it was $1 trillion, I don't think he would feel as motivated to taper as quickly. And by the way, the taper thing, talking about tapering is much, much different than actually doing it. In my head, I go back to a time, it was in August, I think about 3 or 4 years ago, where James Bullard came out one day saying that, the Fed was going to allow interest rates to normalize and go back higher. And then in the next 3 days, the stock market cracked like 7 or 8%. Now, granted, 7 or 8% is not the biggest thing. And then by the end of that same week, he came out again and said, the case for raising rates has changed quite a bit. Now, the only thing that has changed is that the stock market broke 8%. So the question is, do they want to be at the helm where there's any sort of big stock market correction where everyone can point a finger and blame them? And I don't know. I guess it's just human nature not to want to be the bad guy. But if you keep pushing it down the road, somebody's going to be the real bad guy when it all of a sudden adjusts.
Well, the other thing that's happening, too, sort of the political drama behind the scenes, is if you want to be the bad guy, Jay Powell, then we're going to replace you. We're not going to re-up you. I mean, there's a lot of leftists that want Jay Powell replaced by somebody that is even more of an acolyte of modern monetary theory than he is, so that the good times can keep rolling.
Yes, it's absolutely absurd that he has to be, his back's against the wall. There's really, and I see he seems like a good guy to me. I don't think the Fed is doing a good job in general, but I worry that they're going to, if he doesn't give them the just rampant dovishness that they want, they're going to replace him with someone who's more leftist, and all of a sudden they're going to be asking the Fed to fix climate change, to fix wealth inequality, which, by the way, is absolutely comical when you consider over the last 40 years the Fed has been one of the main drivers of wealth inequality. I know to go into that equation would probably be a little too in the weeds for this show, but believe me, it's true. And now to ask them to be the ones to fix it, we're in bizarro world, Dan.
I was reading reports that outside of urban office space, actually commercial real estate is recovering quite well. Multifamily back to pre-2020 and in a lot of cities, rents rising nicely. Of course, that's inflation related too. But the dire predictions about commercial real estate being an anchor, were those overstated?
Yeah, I think they were, and I think that with part of the $120 billion buying a month and the injecting money into the economy as much as they have was to try to support the real estate market in all forms, and I think they've done that. I will actually even argue that they've overshot the mark. Why in the world would they be buying $40 billion of mortgage-backed bonds a month when the home prices have completely skyrocketed? But then commercial is going to always follow to some degree, despite the fact that the story was everybody was leaving cities, no one was going to go back to the office anymore. I think that that doesn't matter as much as the fact that they're just the market is awash in free money.
I mean, just for clarity, going back to those proposed rate increases in corporate tax rate and long-term capital gains, it's a few percentage points, but on a percentage basis, those are big increases. Is that already built into, or the level of increase, if there is any, that will have a material impact, regardless of whether the spend is 0, $1.5 trillion, or $3.5 trillion?
I think that the market is saying that's not going to happen. And I think the market, if it really believed that all these tax increases were going to happen, I think it would be somewhat catastrophic. Because remember, small businesses still, the government has an absolute foot on the neck of small business, and it happened with the lockdowns. And that's why I read the other day that 90,000 restaurants have closed. But now they're going after medium-sized business with the new COVID regulations. I mean, that's that can be a heavy weight for 100 employee business to now have to regulate that, and they don't seem to care. So they're just raising regulations and raising taxes, and realistically, it's all the same thing. So I think the market is saying it's not really going to happen. But if it did happen, it's a huge deal. I mean, so many companies right now are just hanging on by a thread. To add a couple more percentage points, it's an awful idea.
Amy, you know how Jim Iuorio is doing very well and he's hedged properly?
How?
He uses phrases like somewhat catastrophic, just in passing, just flippantly, somewhat catastrophic, not a big deal.
Yeah, it's kind of catastrophic, but not really.
Yeah. It's Hindenburg, not Titanic. I got you. Great. Thanks so much, Jim. We appreciate that. Jim Iuorio, Fox Business analyst, owner of Brandt's, which I hear has the best burger in town there in Palatine. In the region, I should say.
You didn't have the burger. You didn't even give it a try.
The ribs are good.
The burger is the best.
I will endorse the ribs for sure.
And your tacos now, too.
Oh, the fish tacos. I love those. That's what I have tonight. Yeah.
Amy's keeping up on your menu. Very good. Jim Iuorio, thanks for joining us. Appreciate it.
Here you go.
And he joined us on our turnkey.pro answer line.
Listen to Dan and Amy on your smartphone. Download the AM 560 mobile app today at 560theanswer.com/mobile.
High winds, hailstorms, floods, and tornadoes can damage your property. You may have real damage for an insurance claim and not even know it. You could call your insurance company, but they'll send out their inspectors that work for them, get paid by them, and represent them, not you. Or you can call my company. This is Dan Lights from Crosscom.